Hello, everyone. Thank you so much for joining us today. I just wanted to provide you a quick update of the IIE's 2025 Investment Challenge. So we are in phase 6 and we are in the portfolio management and cash out phase. So for the last month, you'll be finalizing your portfolios and maximizing your profits. We have our market expert to give you an overview of what's happened in the last month, but I wanted to highlight our campus performance. Overall, we have VC Online, VC NMB, and VC Sandton leading the pack in the top 3. We have a different story when it comes to campus portfolio profits, however. There we have Pretoria, Westville, and VC Durban North leading the pack. Our top 10 online performers are Aaron, Zachary, and Anil. Congratulations, guys. Hold on to those titles for the last month. On the campuses, we have Andile from NMB, Deshan from Durban North, and Oyama from Nelson Mandela. Well done, guys. Keep up those top performing portfolios. All right, and with that, I'll hand over to Michael Grobler, our trading maestro, a 30-year veteran in local and global markets, to take us through what's happened in the last month on the Dow 30 Industrial Index.
Hey everybody. Yeah, we're just testing this quickly. Okay. Let me just share the appropriate screen. Okay, hello everybody. I hope you guys are all great. It's afternoon for me, so depending on what time you're listening to this, good morning, good afternoon, or good night. Before I get started, I was just actually observing this market update that you guys get. It's pretty awesome. I mean, I was to get these kinds of updates it's nothing I've ever seen before at a challenge level. Certainly not, professional campuses. So really well done to you guys, especially the VC Online. I mean, look at the level of outperformance here. It's fantastic. And then to the leaders of the pack, well done. It actually puts you under a lot of pressure. But, I mean, your performance has been great. And I'm going to show you your comparative performance against the benchmark that you've been in to see. I want you guys to get context on how the performance is versus what shares you've had the ability to invest in, etc. But wow, this is really cool update here. See, Goldman Sachs is very popular. United Health doing well. Microsoft heavily traded. Awesome. Yeah, so let's get started. Today I was hoping to take you through a couple of things. The first is just one profound lesson, something to think about, to ponder on in the coming months, weeks, and years, to take after this competition. And the second is we're going to speak about the importance of asset allocation versus equity selection. And then we're just going to check out some of the big hedge fund managers as well as the market and see how has everybody performed year to date. And you guys can compare yourselves to those fund managers, those so-called super investors. So Here's your profound lesson for today. What is the only unrenewable resource in the whole world? I'll give you a few moments to think about it. Is it oil? Is it iron ore? Is it food? Is it water? The pursuit of this resource led founder of the country of China, Emperor Qin, to drink mercury in search of this resource. With all he had and all his power, he was still desperate for this resource. Couldn't create any more of it, couldn't steal it from anyone, couldn't conquer another nation to get more of it. The answer is obviously time. Now, just to give you an idea of how important it is to invest in the future, and at this point, we think of it as a game. We think of it as cool and, stylish, and the potential to have amazing things and impress friends and prove yourself and get all the things you want. But here's a little known fact. What is the average age of death for individuals who retire at the standard age of 65? This is the expectation of all people living in the modern world. It used to be a little bit younger, and then, government debt levels, etc., and now we're at 65. And then once you hit 65, you can finally receive your pension funds, which you've already been taxed on. But then they'll tax you again when you receive them. So you'll be lucky to get 25%. And that's if you make it to 65. So the average age of death for every individual retiring at the age of 65 is 66. Now, if that doesn't go to show you that the modern system is completely broken, then I don't know what possibly could. The system is designed exclusively to recycle the money. You hardly ever get to enjoy it, even if you do make it past 65. But like I say, you're taxed into oblivion before you ever get to spend it. Plus, given the fact that you've had to wait 40 years or so to get the money, the buying power of the money is greatly diminished compared to the days when it was produced 40 years ago, when it had obviously far, far higher buying power. So the average age of death for individuals who work until they're 65 is 66. Do you know the average age of death of individuals retiring at the age of 55? So the ones who beat out the 65-year-olds by just 1 decade, which is pretty impressive, but not mind-bogglingly impressive. The answer is 85. That's the difference in 10 years of less work. Forced work, labor, stress, debt, all of the things that come with a normal working life. They really catch up to you. So if you're ever in doubt of the importance of the work you're doing here, learning to invest, remind yourself that having money is nothing short of the power to give life. And a lack of money is not just the power to ruin your life, which is the concern most people have. They're worried about having no money will ruin your life. It will ruin your life, yes, but it will also take your life. And that is a real fact of this world. If you have enough to survive, you'll do okay. But if you get an excess, you'll be able to buy yourself what is the equivalent of your average ages as you sit there. Many of you are between the ages of 20 and 25. Your entire lifespan can be bought for money. I just think that that's something you should always remember when you spend money. You give away more than you could ever imagine. And when you use money to make more money, you give yourself more than you could ever imagine. And if you get to the point where you have such abundance that you've sorted out your own life and your own money, you can start to give this life money to people who you love or who need it. A profound and highly impactful gift. Keep that in mind. The way you do this, by the way, is to never, ever, ever sacrifice the important for the urgent. Remember to build up your wealth. Do not let the world consume it. Fight for it, defend it viciously, aggressively. If people would take it from you, don't spend unwisely. Learn about what you have and keep it. Keep what is important. Don't submit to short-term pleasures, short-term competitive behavior, trying to keep up with your friends. Futile exercise. If you just stay the course, you will have more than all of them put together. And a long, long life still. And a healthy life. Okay, so what we're really going to cover today is asset allocation versus stock picking. So, research suggests that sector allocation or asset allocation can account for around 30 to 50% of an investor's performance. The remaining performance, roughly 50 to 70%, is usually attributed to individual security selection. So if you're looking at a company that you want to buy, say, for example, Apple, you've decided that you like it on a fundamental basis, or you decided that you like it on a technical basis or any kind of basis, and you want to grab this share, you want to own this share. But if all you focus on is the stock itself, you might face a serious performance challenge. The reason being is that the stocks do not exist in isolation. They float around in an ether of a number of variables, and you have that universe of investments in those different ether to invest in. So let's start at the bottom. Because normally people simply focus on the top section, giving you which security they should buy. So they've got a general idea that they want to buy Apple, and Apple is a stock. Okay, cool. That's about where it ends for them. So let's look at your entire investment universe. At this stage, it's limited to planet Earth. So we'll start global. Globally, we have factors like war, conflict, pandemics, peacetime, trade relations, and sanctions. So, for example, if you bought the world's best share at the world's best price just before the COVID pandemic, it wouldn't really matter because you got vaped. You just got wiped out, like 40% down every stock minimum. You didn't make any errors in judgment on a qualitative basis on your own stock. Unfortunately, the whole bottom fell out in the entire world at the time. So there was nowhere to hide in the stock market. I'm sure there were other places you could hide, maybe gold, maybe bonds, a number of places, but it certainly wasn't the stock market globally. So again, whichever stock you decided to buy, you were probably suffering performance-wise during that period of time. So even the people who bought Security One, Apple, which is a stock, and all that's all they considered, they were still very much subject to the pandemic's outcomes. They would be subject to a similar thing if there was a war in America. These kinds of things, had they invested in America or a war in their own country. So these kind of global overarching themes, they shouldn't be obsessed over, because a lot of people obsess over them to the point where they almost never invest because, the world's going to end tomorrow. But it's good to be cognizant of them in the first place. Then you go down to country level. So you've got a stock, again, great stock, best price. But you could have an ANC government, or you could have a Labour government from England, or you could have Republican Party government from America, or you could have Vladimir Putin's Russian totalitarian government. So those are completely different governmental regimes and also a completely different quality of government. The people running those respective places are of a different standard, whether you agree with their policies or not. They're all of a different standard. So you have to work within the limits of these people, whoever our fearless leaders are at the time. There are also certain financially applicable rules. For example, if a country has a particular credit rating, its banks will tend to not have a higher credit rating. In other words, if the country is inherently unstable, the market will demand more interest from that bank to lend the bank money, simply by virtue of the fact that it's in an unstable place. Would you rather put money in a South African bank or a Mozambican bank at the moment? Right now, Mozambique's having some challenges. We have challenges as well, but you're probably more likely to get the money out of our bank. And that kind of dynamic changes on a constant basis. I'll give you an example, actually. Economically, a lot of people think of France and Germany as very closely aligned, obviously with Germany being slightly more powerful in every regard, including economically. But for the most part, similar populations, living in the same area, fighting with each other for however long. So in 2008, Germany had a debt to GDP ratio of under 70%. And France had a debt to GDP ratio of under 70%. Today, Germany has a debt to GDP ratio under 70%. And France has a debt to GDP ratio of 120%. Germany has an annual bond yield of 2.7%. And France has an annual bond yield of 3.5%. Greece has an annual bond yield of 3.4%. So far has France fallen that they are now considered a higher credit risk than Greece. So things can change at a sovereign level in quite a short period of time if you think about how long France has been around. Then you can choose your sector. So sectors are highly important. You're either going to be in commodities or industrials or property or financials. Those are your your four main sectors, and then you get a lot of subsectors. So commodities can be broken down into gold, platinum, iron ore, endless number of commodities. Industrials can also be broken down into an endless number. If you go arms manufacturers, you've got, factories for couches, all sorts of stuff, but it's all industrial, but it's all subsector. You get property, also subsector, you get office, you get commercial, you get warehousing, you get township, you get residential, everything you can think of. Financials are obviously virtually limitless. You get PayPals to Visas to banks to everything. And then once you've, traversed the nightmare of that whole experience, you hit your actual stock. So let's look, for example, at America. We're going to look at the S&P 500's performance year to date, or 1 year performance. So you go and buy stocks on the S&P 500, and you decided to yourself, I'm going to buy something that's relating to finance that's not a bank. So that's pretty specific. So here we have the SPY, the S&P 500 is the candle line in the middle, blue and black. And then there at the top, we have Visa in blue. And at the bottom, we have PayPal in green. So you could have satisfied your investment desire by buying one of those two. It would have satisfied, you don't want to buy a bank, but you want to buy a financial business. So that would have been either PayPal or Visa. But the difference between Visa's performance at 27% up and PayPal's performance at 10% down, that is a 37% spread in performance. Enormous. Because there still remains a slight nuance between the business model of PayPal and Visa. Visa has a slightly different process, even though they're both online payment processing companies. I mean, you've been pretty granular here. I mean, there's thousands of different business models, and we've already refined it all the way down to online, software-related, financial business, payment processing, US market, planet Earth. We've really got it down. And still such variation in the performance. The one, Susan would have outperformed buying Visa and John would have underperformed buying PayPal because the market benchmark there has performed about 17% over the period. So you've actually embarrassed yourself. You could have just bought an index tracker and you would have outperformed our friend who bought the green line. Even though he's been so specific, he's bought virtually the exact same thing as the other investor. And that tiny little shift in sector allocation versus stock selection, it gets him all the way down here. Still can be right, can be wrong. And both companies, as a matter of interest, are financially exceptionally healthy. Now let's do the same thing with the South African market. This time we'll do someone who's decided that he wants to, or she wants to buy a stock. She's decided she wants to buy a stock on the JSE, on the top 40. She wants to get either Harmony, which is a gold producer, or Thungela, which is a coal producer, or Impala Platinum, which is a platinum producer. So this person has gone so specific as to say South African stock commodity index. Let's see what we get. So Harmony is up 114%. Impala Platinum is up 81%. And Thungela Coal is down 13%. The market is up 32%. That minor difference in selection of specific details, once we've refined our entire model down, can have a very big impact. But if you go a little bit backwards, you'll note that there's actually a completely different set of dynamics for those three commodities. The one is gold. So gold goes up when fear goes up. Platinum tends to not go up when fear goes up because platinum is an industrial metal that wants positive economic data. So it most of the time tends to go down when fear goes up. And then coal has just been going sideways, as if there's no inflation or whatever forces are driving the other two don't seem to affect the coal. They have their own entirely idiosyncratic group of impacting variables, even though they themselves are commodities on the South African Stock Exchange. And we're buying a very limited scope of different stocks. And you're seeing an absolutely different universe of performance. You take 114%, you add to it 13%. that is like years of returns that have been achieved by the person who made that sector selection correctly. Even though all the businesses call them approximately the same quality businesses. Then, furthermore, let's go back to America. So you can see there that the American stock market is up 12, 13%. So 16, 12, 13, 14, 15, 16%, something around there over the period. And it has been powered by an enormous AI revolution and enormous amounts of capex and spending, powering this incredible stock market up with all its incredible capital and talent. Look at our market, double the performance without even trying. So a trader who's average in South Africa, had they simply broadly selected the correct sector, for example, we don't know which of the gold companies was the best performer by looking at this chart, but trust me when I tell you all the gold companies have shot up approximately to that level. And all of the platinum companies have moved approximately to that level of the blue line. And all of the coal companies have moved approximately to the level of Thungela down there at the bottom, like Kumba Iron Ore, very unimpressive trade this last year, etc., even though these are all exceptional companies. So you could have dartboarded the sector and outperformed an American buying the best stocks in the whole of America. So you take a lot of pressure off your equity selection by choosing the right. The lower you go on the pyramid, the more impactful the decision. You can buy the world's best stock, but if you buy it in like, Syria mid-civil war, that's going to be a problem. Or you can buy a really terrible business in a really fantastic country that makes life easy for its business. Like Singapore, for example, where they really promote and stoke business. You've got a much better chance of doing well with a in that country, just broadly speaking. Less friction, more consistency and stability. It also allows you to fund the company more effectively because your creditors won't demand such enormous interest rates, etc. Okay, so everybody looks at America, so you get quite focused on America. But the funny thing about America is that America's stock market since 2009, it has performed as per these lines on this screen. And at the moment, every year it has performed a line. And at the moment, it is performing the bottom line. So in other words, America is actually having its worst stock market performance relative to emerging markets like us. That's why I've showed you earlier that our stock market has doubled the performance of America. So with all the talk and all the noise and all the AI spend and all the attention we give America, America's performance this year has sucked. And had you been in any other country, you would have had a better chance just by pure flows of performing well. We're third from the top for the same period. So you'd have been better off, rolling up the roads and just stopping the trading in America for that year and just getting directly into South Africa and broadly buying gold shares indiscriminately, and you would have just massively outperformed some financial scientist who was analyzing the discounted cash flows of this company. You know what I mean? It allows you to be more, it allows trading to be more forgiving if you understand these concepts, because if you put enough tailwinds behind you, so you buy a good country, good government, cheap market, cheap sector, useful sector, barriers to entry in that sector. And then you've limited the number of shares you'd actually consider owning on this earth to like 1,000 instead of the 60,000 you could choose from. So it's important to keep that in mind. That's the ether that American market is floating around in. And you can be like the fastest runner on that chart. You could just be like the best. And you're still sinking. You're sinking. And there's nothing you can do about it. It's like being the fastest guy to climb to the top of the sinking ship. Okay, so just keeping that in mind, that flow of sort of like macro down to country, down to sector, down to subsector, down to subsector. So here's an example of the year-to-date performance of the Dow, which are all the shares that you folks have access to. And I've put them into sector. I've split them in sectors. So let's check this out. So the only share that's in the healthcare services sector in the Dow at the moment is United Health. So United Health, you can see, has done quite well there. It's the only healthcare stock. So let's ignore that for now. Look at utilities. So utilities are all the things, the basic things you need to live. So think not like food, but like, electricity and water and stuff that keeps human civilization ticking forward. Sometimes those are considered to be quite defensive stocks because you can live without microchips, but you can't live without, air and water and lights. You can see that this sector has performed broadly well. You could have dartboarded this, and you'd probably have made money if you bought 3 stocks. Let's look at the extent of their movements. Not bad, 19%, for half a year, that's a pretty good return. Again, pretty good, again, pretty good. Had you bought transportation stocks, you would have had half as much chance of being right. And look at the losses here on utilities are very minimal. So even if you messed up and you bought the only 2 reds, you'd be okay. But if you messed up and bought the wrong transportation sector stock, you'd have some serious problems. These are like proper moves down here, 29%. So simply avoiding the transportation sector and favoring utilities this year gave you a structurally embedded advantage over the other traders in the competition. Do you understand the concept of setting an advantage in place before you even start? Obviously, your universe is limited to the Dow, so this is your universe. Let's look at consumer non-durables. So things like Coca-Cola and Procter & Gamble that make like lots of stuff for your house and like bathroom and all sorts of stuff. But basically, and Nike. So what do these 3 things have in common? Well, they all face the US consumer. And if people in general have less money, then this sector doesn't do well. You can just buy fewer Nikes and buy fewer Cokes. Any investment into this sector, as different as these individual shares are, what does Nike have to do with Coca-Cola? Nothing, except that they face the US consumer. And as a result, they're wiped out. Now, it doesn't take a rocket scientist to know that Coca-Cola and Nike and Procter & Gamble are probably pretty good companies. And they've been around since, forever. So you could know that. And you could come to me and say, that's why I bought it. And I'll say, well, that's a pretty legit reason to buy something. And then this happens. Let's look at health technology. Wow. Okay. Yeah, you were smashing it. Yeah, you've got Johnson & Johnson and you've got Merck, the sort of the medical vaccination company. Over here, you could have bought, look at the little difference. You've got technology services. And Yeah, you've got electronic technology. Electronic services only generated 4% best case. IBM's flat and Salesforce went down badly. Whereas had you bought these two guys, you'd have done very well. Here you would have lost. Here you would have been flat, and here you would have been flat. So far more less sector specific in this instance and more stock specific. So once you go into the sector, you are hoping that the whole sector will broadly face tailwinds. Then you are going to look with a little bit more concentration into specific areas in that sector. You don't want to be involved in process industries. Communications is Verizon, so they make, they're like MTN and Vodacom of America. Trade a lot like utilities because it's basically become a human right. Okay, so you've got the idea there. Okay, then we've got another ether that you're floating around in the whole time you don't even know about. So let's say beginning of the year, we bought these dollars that you got in your trading account for real. And at that point, the dollar was at 1950, say, for example. It's currently at 1750. So you buy these dollars and then you go out and you buy American shares because you have to buy American shares with dollars. You can't buy American shares with rands. So if you decide in real life that I'm going to be a person who's going to own American shares, you've got to go somewhere and get some USD, some Benjamin, and you need to go and buy yourself some Apple or whatever. The problem is that the very currency that you've bought itself varies in value. So let's say you bought 20 shares beginning of the competition in real life in America with currency that you bought the day before in order to buy those shares. $500,000. And none of the shares moved. They just switched the stock market off for like the whole competition, a real buzzkill. So we can still look at the currency movement. So over the same period, the US dollar's gone down by 15%. So on every 100,000 Rand you had, you've lost 15,000 bucks, even though the shares didn't move. And this is a major consideration in real life trading and investing, because if you buy the underlying currency with which you are planning to buy the stocks at a time when that underlying currency is expensive, the underlying currency's depreciation, even if taking place during the appreciation of your correctly, smartly bought share, will still result in a loss. This is another example of sector allocation. The currency you buy the stocks in must itself be cheap at the time of the buy. Because if it isn't, it'll permanently work against your investment on an actual net Rand basis. Because at the end of the day, we need to turn the money back into Rands and go and spend it on wine and Porsches and stuff. So when we do that, we're going to turn that money back into Rands at 1750. And we're going to lose $2 on every single dollar that we bought originally. We're going to lose 2 Rand that we just gave the market. Now, very much like the earlier slide where I showed you how the American stock market has underperformed, so has the United States dollar underperformed absolutely horrifically this year. In fact, it's having the worst opening to a year it's ever had. And their stock exchange is having the worst year it's had since 2008 crisis. And when you're trading stocks, you don't think like this is the actual state of things behind the news. This is what your stocks are made of. They're made of a material. And if the material starts to break down, it doesn't really matter how expensive your house is. If the materials of the house start to degrade while you own the house, you've got a serious problem. So this is exactly what's happening if your currency is decaying during the time that you're owning the stocks. However, if you bought US dollars, for example, now, and it did move up higher, and your stocks gave you, say, for example, 15% in returns, and the US dollar went back to its all-time highs against the rand, you would close the profit at 30% profit. 15% of the profit is comprised of dollar appreciation, and 15% of the profit would be comprised of stock appreciation. I really appreciate that. Okay, so the reason why I'm telling you all of this is because the hottest thing in the universe right now is to buy chip manufacturers and AI, and it's all this epic revolution. And I have concerns that in the long term, the technology itself is sound, and it will certainly, it already revolutionizes the world. But from the perspective of being able to monetize these profits, I just want to give you a sense of how much the large technology companies in the world are spending on AI, and also how many academic papers have now been researched and published that give information on the practical uses and practical business outcomes. So you've got to differentiate with yourself mentally how useful AI is to you, and then ask yourself, that given known fact that it's greatly useful to you, if these people are spending $40 billion every 10 seconds on upgrading infrastructure, how will they make the money back? Like, how much money have you actually spent on AI in your life? And you guys are on the cutting edge. And you guys are on the cutting edge. So you should be spending the most. You should be fully involved, whether everyone's for it or against it. It's part of our lives now, so build a bridge. But how much monetization have we actually given to this technology? So just some findings in general research on AI in business today. And I mention it in this trading competition because the theme of the market is obviously and undeniably all AI all the time. NVIDIA is flying. PayPal is crashing, not because it is a bad business, but because people think that the AI is just going to price them out of existence. And we won't need it anymore. And, these kinds of arguments. So while initial hype drove rapid adoption, many organizations are grappling with limited returns, slowing momentum, and practical limitations in AI's capabilities. Below is a curated summary of the highlighted findings, verified and expanded with details from primary sources. MIT's Project NAND, the Gen AI Divide, State of AI in Business 2025. This study revealed that 95% of enterprise generative AI pilot programs failed to deliver any measurable financial returns. Highlighting a Gen AI divide where experimentation outpaces scalable implementation. The core challenges include integration hurdles and a lack of clear business alignment, leading to widespread project abandonment. So very much a solution without a problem. Not a lot of people know how long blockchain has existed for. It's been like 40 years that the technology's technically existed for. And they've done 150 trillion different use case studies on it. And so far, we're trading tokens. Now, whether you like the tokens or you don't like the tokens, enough time has passed for these folks to figure something out, because, man, I mean, just my observation. So I'm all for, robots making me coffee and all sorts of these amazing things, but a lot of the time you've got to separate how you feel personally about a technology and then the actual practical implementation of generating revenues from given thing in the long term on a sustainable basis. Like back in the day, you used to go to the cinema and you paid like, whatever, $100 to watch one movie, and you paid another 18,400 Rand for popcorn and tumbles, and then and a small Fanta, and then you went in and you left. Now you pay $100 for Netflix, $200, and you get every movie, in the universe. So it got monetized, but it got compressed into virtual obscurity and oblivion before it was monetized, and then you had to be the scale of Netflix to make money. And Ster-Kinekor and all of the rest of them are totally on their last legs. So then we have another survey. Despite 80% of companies deploying generative AI in some capacity, the same proportion reports no material bottom line impact on earnings. The report attributes this gap in talent, governance, and value capture strategies, urging a shift from the broad experimentation to targeted, high impact use cases. So they're trying to sort of get it to do something useful by getting it to focus more on specifics. Then we have the US Census Bureau did Trends and Outlook survey. For the first time since tracking began in 2023, AI adoption among US firms with over 250 employees has declined, dropping from 14% to 12% in the latest quarter. This reversal among larger enterprises signals cooling enthusiasm and economic pressures and unmet expectations to smaller firms and continue modest uptake. This is very similar to electric vehicles. Electric vehicles have their place in this world. They've got their fans. But everyone expected them to grow essentially unlimited growth until ultimately every single vehicle on Earth was an electric vehicle. So in a lot of European car company, automotive companies, etc., governments, they all pivoted in this direction. And then at the end of the day, it fizzled out. So they did okay, but we're not all driving electric vehicles, and Tesla's been around for like over 10 years, 20 years now, and it's going to become a thing, but it's this sort of infinite blue sky concept of sales, this limitless potential demand has simply not materialized. So all the money that everyone put into these, for example, in China, they've got such excess production of electric vehicles because their own population are not buying them as much as they expected them to. They now dump them on Europe, and Europe has to tariff them. And now China's bringing in their electric vehicle production into German factories because the German factories are not producing cars because they've pivoted their business models and no one's buying their useless electric vehicles. So now, to avoid the tariffs, China just brings their manufacturing into Germany and then ends up giving the German people their own electric vehicles anyway. And all of this had to happen because some guy in an ivory tower at VW one day decided that, or in some French auto manufacturer, it's the revolution. It's going to just take over. And yes, we will always have electric vehicles. Same thing happened with the internet. We do have the internet. It indeed did change the world, but pets.com is still bankrupt. The NASDAQ went down 85%. 85. Imagine if the market went down 85%. It went down in 1999. And we still have the internet. It's the biggest thing since toothpaste. We all use it. But it succeeded. But the bubble still burst. Do you understand? You can be right at both. You don't have to sacrifice the idea that AI is revolutionary to acknowledge that the market is bubbling over this concept. There are a number of other AI adoption related surveys, etc. I find this one pretty fascinating. Meta did a model evaluating the threat, blah, blah, blah. In a study, it experienced open source developers using these large language models were found to actually be hindered by the performance of the AIs because they spent a lot of time trying to fix problems that the prompting, reviewing, and fixing process required ages, to the point where it's actually given rise to a type of coding specialist called a vibe coder, which does nothing but clean up AI related problems. I find that quite fascinating. It's ironically creating employment. Then the monstrous CapEx information. So Meta exemplifies the escalating financial commitments fueling AI's ambitions. So you've got to understand that everyone is aiming for AGI. Meta, who you can trade, Microsoft, Amazon, all of the Dow companies are all on this epic mission to achieve what's called AGI. So this is the kind of super intelligence that will allow robots to work in factories very comfortably and cars to drive very comfortably. So the next stage of the evolution of our pretty simple at the moment language models. Whoever achieves this will basically become like, all-powerful super company. Because its first mover advantage will be incredibly profitable. So all of these supermassive companies in the Magnificent Seven, for example, are all racing to this technology, and they are throwing so much cash at this thing. It's unbelievable. 17% of their revenues into this CapEx venture. Similar concept to the metaverse, this kind of thing where they're spending inordinate amounts of money on getting to be the first one with a metaverse or with a working metaverse, or be the first one with a GI, general intelligence. 54 billion in the last year alone. 14 billion annually was the original number. So the competitive nature of this is unbelievable. Meta, just the other day, they built half a cloud server farm costing $70 million. And then when the AI revolution happened, ChatGPT came out and they bashed the whole thing down and turned it into a new AI data center for $150 million. So these people are under such pressure. Don't think of them as evil capitalists racing to the top. They've realized that if they don't get there, they are obsolete. They are doing this out of fear, not out of greed. Because their competition are the rest of them, and they are all very capable people and very capable leaders and extremely powerful economic engines, and they've all got enormous advantages and unimaginable amounts of resources. So even if you're a super powerful person, you've still got, there are a lot of people in the world that are just as powerful, and they all race into this point. Now, what's so important is that Meta's depreciation to CapEx ratio has climbed to 3.8%. In other words, they pour money in, but at the same time, the chips become obsolete and they start to become less valuable. So through depreciation. So because you're buying these hyper competitive, ultra latest release NVIDIA chips, next year, your chip's worth nothing. So on an accounting basis, you obviously know they will depreciate this item over time. Only the rate of depreciation of these chips is extremely high. They're like worthless in 2 years. So you're losing like 50% of the value of the chip every year. Now you've got to figure out a way to make 50% of the value of the chip every year, or you're not making a profit. Because next year you've got to go buy a whole bunch of new chips. So the competitive pressures on spending in this sector are absolutely massive. But because the market sort of worships these guys, they want to buy into this argument big time. And they're like, well, Mark Zuckerberg can do no wrong. Of course, if he's putting so much money into it, this thing must be the greatest thing. And then they validate the idea by saying to themselves, and I love AI, but they don't ask themselves how much they've given Mark Zuckerberg for his AI lately. Probably zero. And it'll be zero for the rest of their lives. These companies in America, by the way, are also not working in a vacuum. You've got epic forces in China producing DeepSeek for nothing, with a fraction of the resources, equivalently good. There are many AIs that are superior from a cost-benefit, technology, processing, compute perspective. So anyway. So there could just be a slowing of this concept. And the reason why I mention it is because it will impact your future performance, maybe even in the term of this competition, but certainly afterwards. Then also there's the matter of customer reliance. So everybody knows NVIDIA is the greatest thing in the world. Do you know that 2 of their customers account for 40% of their revenues? What if something happened to, this is the biggest company in the entire American stock exchange. So it accounts for a big percentage of the American stock exchange, maybe 1%. And if it falls, or 2%, if it falls, it drags the American market down with it. More so than a smaller company like a PayPal or a really small company like Sirius or some tiny thing you've never even heard of. 6 of their customers accounted for 85% of their revenue. So if the theme changes, you can assume that the 6 companies are basically Amazon, Google, Meta, which is Facebook, Netflix or whoever, maybe Twitter. So because they're doing Grok. But that is an enormously high level of reliance. Take something like Procter & Gamble. They've got billions of customers. And the whole world would pretty much have to fall to pieces if Procter & Gamble really had to have a problem. Or Coca-Cola have literally billions. And if you take it on the temporal dimension, it's actually been many billions over time as new people are born. These guys, for this very moment in time, have 40% of their revenues coming from 2 customers. And if anything happens with those customers, it's tickets. And then by virtue of it being tickets for NVIDIA, it's tickets for all of us as traders, because not only will NVIDIA fall, but it will drag the entire sector down with it, the entire theme down with it. And everything that's touching this thing will get annihilated. And if you don't believe me, even Jeff Bezos himself is warning of this. Talking about how, I almost get the sense that these folks, because remember, this guy actually spent the most money of anybody on AI so far. They have the highest CapEx spend for AI. Zuckerberg's close behind. And this guy is starting to soften up the market to the idea that, hang on, guys, we might not just, turn this into super bucks as soon as you think. I do think that it will, there's no difference between a rand saved and a rand earned. There's no difference. AI will indeed make these companies a fortune of money in savings, which is the same thing as making it in revenues. Because at the end of the day, you're going to have the same amount of money. But to actually sell this thing as a product is going to be quite challenging. Especially if you have shareholders to answer to, that you have to say, okay, we got to the top of the pyramid, we're awesome. We've got the best AI. We spent $200 billion getting there. Anyone know how to make some money out of this so we can get our $200 billion back? Okay, so enough of the AI. So changing back, just a concept or just an idea that something to keep in your mind. It's always important to check the bear case, because right now I know that you've all been filibustered with AI is the next revolution. Yes, it is, and it still will be. And you don't have to. You're not betraying yourself by acknowledging that the market and investing in general, the market is quite expensive in general at the moment. And I'm telling you this at the end of the competition because I don't want to see you get complacent at the end. It's challenging to keep the lead, and it's possible to take the lead, even now, very easily possible. Over here, I just put up an image of the Dow Jones Industrial Average. So the Dow Jones Industrial Average is the ether in which you have been floating. You could have outperformed it. You could have underperformed it. Finding my mouse. The reason why that's up there and not down there is because there's actually a little wick here. So the Dow's down a little bit from the high, but the maximum that you could have made on a benchmark level is 16%. That's what the market's done. So if you want to judge your own performance, you will ask yourself, have I performed at or below 16% or above? And I see that some of you have been up at this 16% level, and some are underperforming the 16%. So to give you an idea of the level of competition and the level of difficulty in the market, the best performers in this competition are matching the market. But should you develop the skills to outperform the market over time, you start to understand the kind of advantages that you will have over others. Where here, even being great is average. Then we have these famous characters. Okay, these are the super investor hedge funds. So just to give you an idea of how hedge funds work, hedge funds are not like pension funds. These guys can go long and they can go short. Also, they are a boutique service. Which allows you to invest exclusively with them. So it's you almost have to ask to invest with these people because they're apparently so exceptional. Furthermore, you give them 2% of your money every year that you have with them, and you give them 20% of all your profits. Not 20% of all your money, but if you make a profit of $10,000, you will give them 20% of it. Plus, you will give them their 2%. These are their annual returns, far right, so far. Bridgewater is the largest hedge fund in the world. They've produced 26%. Pretty good, given the fact that the market produced 16. So this person is outperforming, or let's call it this person, which is comprised of 10,000 finance people, is managing money fairly well. And they're vastly outperforming the rest. Then we have number 2. At 18% is only moderately outperforming the average of the market. Then we have 17, and now if we get to AQR, Apex Strategy, now you would have been better off buying an index tracker. Every single other company has underperformed. Plus, you're paying them. The reason why I show you this is because these are the best investors in the whole world. Citadel is a massive behemoth of investment. Bridgewater is monstrously gigantic. BlackRock pretty much runs the planet Earth. So even they manage just that. There is absolutely no reason you can't crush them completely if you know what you're doing. And not just, I really mean crush them. Like you can do 4 or 5 times better than them from your laptop at a coffee shop. That is the single coolest thing about trading. I don't have 150 scientists working with me, but I promise you, if I had these returns, I'll kill myself. Anyway, guys, I think that'll do it for today. You guys are really doing so well. I'm so proud of you. Keep kicking butt. Don't get complacent. Don't panic at the end either. Remember to follow the rules or you'll blow it. And yeah, those updates, again, super awesome. Keep looking at them. That is some useful stuff. I wish I could just get one of those for my own portfolios from time to time, but I'll have to come to Varsity College to get that. Have a great time, guys. God bless and good luck.